Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Master Profitability Ratios. Boost your financial analysis skills. For example, if gross profit margins are shrinking over time, it might signal rising production costs or pricing pressure. On the flip side, consistent growth in operating profit margins could show that the company is improving its efficiency. Trend analysis is like reading a book. Each year's data is a chapter, and the full story only makes sense when you see how the chapters fit together. Whether you're an investor or business owner, spotting these trends can help you make smarter decisions. Limitations of profitability ratios. Profitability ratios are powerful tools, but they're not perfect. Relying solely on these numbers can lead to blind spots in your analysis. While they offer valuable insights, they also come with limitations that can cloud decision-making. Understanding these pitfalls helps you interpret them with caution. Misleading interpretations. Profitability ratios are simple to calculate, but they don't always tell the whole story. Certain scenarios can make these ratios appear better or worse than they truly are. Accounting choices. Companies can use different accounting methods for depreciation, inventory valuation, or revenue recognition. These decisions can artificially inflate or deflate profitability ratios. For instance, choosing a slower depreciation method might boost net income and make a company seem more profitable. One-time events. Large one-time gains or losses, like the sale of an asset, can skew results. A high net profit margin might look impressive, but if it's due to a one-off windfall, it doesn't reflect ongoing performance. Industry variability. Comparing ratios across industries can be misleading. A tech startup and a retail store have vastly different cost structures. Without understanding industry norms, you might misinterpret the numbers. Sometimes, profitability ratios are like pieces of a puzzle. They need context to make sense. Without digging deeper, you risk drawing the wrong conclusions. External factors influencing ratios. Profitability ratios reflect a company's internal performance, but they're not immune to external forces. Economic conditions and market dynamics play a huge role. Here's how factors outside a company's control can impact ratios. Economic shifts. A recession can hurt consumer demand, shrinking revenues and profits. Even well-managed companies might see declining profit margins during tough economic times. Currency fluctuations. For companies operating globally, changes in currency exchange rates can mess with their numbers. A strong domestic currency might reduce profits from international sales, lowering profitability ratios. Market trends. Rising raw material costs or labor shortages can affect gross profit margins. These challenges may have nothing to do with how efficiently the company operates. Regulatory changes. New taxes or stricter regulations can increase operating costs, eating into profits. Think of profitability ratios as a snapshot. They capture a moment in time but don't explain what's happening in the background. Knowing the external factors at play helps you understand whether changes in these ratios are temporary or part of a larger trend. While profitability ratios provide critical insights, they're not infallible. Use them as part of a broader analysis, not as a standalone judgment tool. They're like a compass, helpful, but only when paired with a map. Real-world examples of profitability ratios. The power of profitability ratios becomes clear when we apply them to real-world businesses. Let's explore how they reveal key insights by analyzing two companies, one successful and one struggling. Case study: successful company. Consider Apple Inc., known for its consistent profitability and high margins. Let's examine a few of its key profitability ratios to understand what drives its financial success. Gross profit margin. Apple's gross margin often hovers around 40%. This means the company retains 40 cents from every dollar of revenue after covering production costs. Apple achieves this through premium pricing and an efficient supply chain. The gross profit margin highlights Apple's ability to maintain a competitive edge, both in cost management and product desirability. Operating profit margin. In one fiscal year, Apple reported an operating margin of roughly 30%. This exceptional figure reflects tight control over operating expenses, including marketing and administrative costs. It also underscores how its product ecosystem, like the seamless integration between iPhones, MacBooks, and services, contributes to profitability. Return on equity, ROE, Apple has consistently delivered an ROE above 50%. This indicates the company generates over 50 cents of profit for every dollar of shareholder equity. Such a high ROE suggests that Apple uses shareholders' investment efficiently, thanks to its strong brand, high sales volume, and robust service revenue streams. These ratios paint a picture of a company that excels in both efficiency and execution. Apple's ability to control costs and create high-value products explains its dominance and appeal to investors. Case study: struggling company. Now, let's turn to Bed Bath & Beyond, a company grappling with declining profitability in recent years. By examining its profitability ratios, we can identify where challenges arise. Gross profit margin. At one point, Bed Bath & Beyond's gross profit margin fell to below 30%. This drop came as competitors like Amazon squeezed the market with lower prices. A shrinking margin signaled the company's struggle to manage cost pressures while remaining competitive. Operating profit margin. The decline in gross margin trickled down to the operating margin, which turned negative in certain years. Rising operating expenses, such as store closures and restructuring costs, ate into earnings. A negative operating margin is always a red flag, signaling that the core business is losing money before even considering taxes or interest. Net profit margin. As revenue declined and operating losses mounted, the net profit margin turned deeply negative. For example, in one fiscal year, the company posted a loss, meaning it spent more than it earned across all operations. This reflects operational inefficiencies and an inability to adapt to changing consumer habits. Return on equity, ROE, also dropped significantly, often into negative territory. This reflected poor returns for shareholders, compounded by declining sales, increased debt levels, and weak profitability. Bed Bath & Beyond's financial struggles highlight the importance of staying agile in a competitive market. Profitability ratios showed warning signs well before the company faced bankruptcy risks. These figures offered insights into its core challenges: rising costs, declining sales, and an inability to sustain shareholder value. By contrasting these two companies, the role of profitability ratios comes into sharp focus. They don't just measure performance, they reveal stories behind success and struggles. This underscores why these metrics are essential for evaluating any business, whether thriving or floundering. Conclusion. Profitability ratios are essential for understanding a company's financial health and decision-making. They uncover how efficiently a business turns resources into profit, offering insights for investors and managers alike. By combining metrics like profit margins, ROA, and ROE, you can build a clear picture of performance. However, context matters. Compare against industry benchmarks, analyze trends, and consider external factors to make informed decisions. Start exploring these ratios in your financial analysis toolkit. They're straightforward, powerful, and a key step toward smarter business choices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.